Welcome, and thanks for joining us. Moss Adams is pleased to present another in our ongoing series of continuing professional education webcasts. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. For example, you can click the File folder icon to download the group attendance sheet and a PDF copy of today's slides. You can ask our presenter questions during the webcast by clicking Q&A in the bottom left-hand portion of the icon bar and typing in your question. We'll do our best to answer all questions during the presentation or follow up via email. We'll ask polling questions throughout today's presentation. Per the National Association of State Boards of Accountancy Webcast CPE standards, CPE credit will be awarded based on your participation in these polls. To respond to a poll, click the button next to your answer. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. Please have all group members sign the sheet, and please remit only one sheet per group. Also note, today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions. CPE credit can be awarded only to participants registered as themselves and is not available to participants who view the on-demand version. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon to open a PDF file you can save to your computer. As a reminder, the presentation you're about to see is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances. We're now ready to begin. Thank you.
Good morning and welcome to today's webcast, R&D Credits for the Aerospace Industry. Before we begin the presentation, I'd like to introduce today's presenters, Tom Sanger, Peter Henderson, and Kurt Lippmann. Tom has practiced public accounting since 1994 and leads the firm's R&D tax services, overseeing all research tax credit projects. He performed studies for companies in many industries, including technology, medical devices, pharmaceutical, aerospace, manufacturing, and electronic device manufacturing. He is a frequent speaker at various industry associations and has authored many articles in industry publications regarding the research tax credit. Peter is a manager in the R&D credit practice at Moss Adams and specializes in federal, California, and Arizona R&D incentives. Peter spent 2 years performing R&D tax credit studies at a Big Four firm before coming to Moss Adams, and has more than 5 years' experience conducting R&D tax credit studies. He has extensive experience in mechanical and high-tech industries, including aerospace, automotive, manufacturing, machinery and equipment, heavy construction, and hardware and software development. Kurt has been in public accounting since 1996 and is the national practice leader of the Aerospace group at Moss Adams. Kurt serves a wide variety of businesses in the aerospace sector, including those devoted to maintenance, repair, overhaul, composites, avionics, interior design and manufacturing, engineering and design, tooling, and precision machining. I will now turn the line over to Peter to begin today's presentation.
All right, thanks, Emily. So before we get started, I'm going to just quickly explain why exactly we're having an aerospace-specific R&D presentation, opposed to just having a general R&D credit presentation. And the reason is that the aerospace industry has some very unique characteristics, some of which have implications on the R&D credit. For example, the industry is characterized by ultra high quality components that are produced at relatively low production levels when compared to other manufacturing industries. Another factor being that the industry has very complex vertical supply chains. And we'll talk more later on about exactly how these characteristics affect the R&D credit. But the final point here is that R&D credits have proven to be very effective and very lucrative tax reduction tool for aerospace companies. And it's safe to say that the R&D credit is really the single most beneficial tax incentive out there in general for companies within the aerospace industry. So with that said, I will pass it over to Kurt to go over the agenda.
And Peter, right before that, what we've seen is the R&D credit also is probably one of the most lucrative credits as a project that a company does in a year. And so as we've gone through this thing, most of our clients and those who knew about the credit or didn't know about the credit realized that it is definitely worth the time to understand it, because it's probably the number one profit generating activity that they did throughout the year. And so that's a big one, is just the dollars that are involved.
Yeah.
Thanks, Peter and Tom, and for everyone on the call, thanks for joining. And this is Kurt, and I'll be the moderator. And I was just going to add a comment on there as well, that just for the aviation industry, I think that it's pretty fortunate to be able to, I think there's quite a bit of case law that supports the aviation industry. I think there's even a specific IRS industry guide for taking the research credit in the aviation industry, and just in general the bipartisan support for it. So overall, I think supporting what you were talking about, Peter and Tom, it's just that it's great for taxpayers to take advantage of the credit.
That's a great point. And if those who are listening, want access to the IRS Audit Guide, it is out there. But if you email us, we can definitely get that to you. One point on the IRS Audit Guide is it's probably 5 or 6 years old, and it's not necessarily taxpayer friendly and updated for all the new court cases that have occurred. But it's a good indicator of kind of some of the areas that the IRS was looking at, and in some cases the various field representatives are going to be utilizing that. So it's nice to see. So shoot us an email if you'd like a copy of that.
Okay, on today's agenda, we're going to break it into 3 parts, starting by getting technical. So organizations can either start qualifying or maximize the credit. And then we will move into some more specific aerospace matters. And then the third part will just be basically some recommendations on direction and next steps. So before we start, Peter's going to kick us off with the R&D credit qualifications, but actually we're going to move right away into our first polling question. And it's an easy one for everyone just to get started with, and here it is. So are you currently claiming the R&D credit? And so I'll let everyone answer this as for a second here, and pause for a minute, but just in general, I also want to let all the participants know that we work with organizations that are lower revenue, I'd say under 20 million, and then with organizations that maybe exceed 500 million. And our objective here is to make sure everyone is taking advantage of the credit, either by maximizing it or by starting to take advantage of it. So just a reminder, it was mentioned, but to complete the questions, you need to complete the questions to qualify for the CPE, and you need to hit submit. So I'm going to go ahead and forward on and see what our results are. Good. So Tom, that's probably, and Peter, that's probably not a surprising result, just because a lot of people are still learning about the credit.
Yeah, definitely. I mean, that's pretty much what we've seen, and also why we continue to do these presentations is there's a lot of companies out there that have significant benefits that they're not taking advantage of. And the R&D credit was developed to basically give U.S. businesses a competitive advantage globally, and so Congress wants U.S. businesses to do that. And as a follow-on, a lot of states wanted businesses to locate in their states, and so they have credits as well. But this is a credit that is desired by Congress and by the government to basically help companies to invest in technologies and process and development and things of that nature. So please do take advantage of it if you do qualify.
All right. Peter, can you take us into the details?
Yeah. Sorry, slides are jumping around here a little bit. But does your company qualify? And here we're going to transition into the actual types of activities that qualify for the credit. And before going into the actual rules, the first point here is that it's important to note that book or GAAP or accounting R&D is different than the tax credit definition of R&D. And the tax credit definition is actually much more expansive and includes a lot more than the traditional accounting or GAAP definition. So a lot more tends to qualify than people often assume. And the next point is it's important to note that the credit is not at all just limited to internal R&D activities. So you can still be eligible to claim the credit on development activities that are being done under contract. And this is an especially important point for the aerospace industry, just because unless you're one of those top tier or OEMs such as Boeing, GE, Embraer, then the vast majority of work that you're going to be doing is likely going to be under some type of contract for the most part. So just because you're working under contract and getting paid for the development doesn't necessarily, or it doesn't mean that you're prohibited from claiming the credit, but there are some additional steps, some additional criteria that need to be met, and we'll discuss those later on. So with that said, go ahead, Kurt.
Oh, I was just going to pipe in there and just ask, I mean, so typically smaller organizations, what viewpoint do they typically have related to whether they qualify or not?
A lot of small companies within the aerospace and other kind of mechanical industries, manufacturing industries, just simply aren't aware of the credit, and a lot of them, if they're working under contract, they don't see it as being R&D because they're kind of stuck to that traditional definition of R&D where it's you're not working under contract, you're developing something internally, which is not the case. So
yeah, the thing that we hear a lot just right off the bat just relates to, well, this is what we do for a living. This isn't R&D. This is, a customer comes to us, we build it, and we engineer, design it, build it, and we deliver it, and that's what we do for a living. And they know that for the most part, if it's just mass quantity parts and doing the same thing day after day, year after year, it's probably being outsourced somewhere else where they're being asked to develop and design highly engineered components, and every day it's a new challenge. And they believe that's kind of what they do for a living, therefore it doesn't qualify. But under the definition that are done by the government, they do qualify, and so just keep an open mind, and as Peter goes through the next section, you can kind of see that if your company is doing these types of activities, bells should be going off that there could be some very lucrative credits involved.
Yeah. So the tax code defines R&D as activities or expenditures that meet the 4-part test listed here. And as the title suggests, there are 4 requirements, and you've got to meet each of those requirements, opposed to just one of them. And we'll go through each of these individual requirements on the next slides, but just I'll read through them once here. So there must be technical uncertainty. There needs to be a process of experimentation. The activities need to be technological in nature, and they need to be done for a qualified purpose. So technical uncertainty. This requirement is that the activities must be intended to overcome some technical uncertainty regarding either the capability, the method, or the appropriate design of the product or process. And this essentially requires that you don't know, or you can't know how you're going to get to your end result from a technical perspective from the onset of the project or the outset of the project.
The other area that some people who may even thought about the R&D credit 10 years ago or longer, it used to be you had to be doing something that no one in the industry was doing. And they've switched it to or. And so if you don't know the appropriate design, then you can qualify, even if you have competitors who are doing that. And so that's been a big change in the last decade. You don't have to be expanding the technical knowledge in the industry. You just need to be expanding your company's technical knowledge.
Yeah, that's a good point. And another point on that is that if you're adapting an existing product to a particular customer's requirements, so say you've already made some type of product and and you want to adapt it to, say it was originally made for a regional jet, you're adapting it to an A380, there could be technical uncertainty as to the capability or method of which you're going to accomplish that adaptation. So there's definitely some opportunities there. Next requirement is process of experimentation. And so this essentially requires that there must be some type of experimentation in order to eliminate that technical uncertainty mentioned in the last point. And this can be systematically evaluating different design alternatives throughout the development process, conducting various types of testing on those alternatives. Anytime you're using a systematic trial and error evaluation process, you've met that requirement there. Next up is that the activities need to be technological in nature. And this is generally the easiest one to me. It just requires that the activities need to rely on the hard sciences to some extent. So hard sciences would include physics, electronics, chemistry, various forms of engineering, computer science, etc. Things that are not considered hard sciences are, as you'd expect, market research, logistics, vendor-supplier research, social sciences, etc.
That's one of the big questions that pops up on this one just relates to like Six Sigma activities and whether they would qualify or not. And I guess the answer, like a lot of things in tax, is it depends on the facts and circumstance. And a lot of times, portions of it do qualify. And as even Peter mentioned, the IRS kind of says, vendor, procurement may not qualify. But if procurement is needed to acquire parts or components that are going to go into the project, then it could qualify. And so a lot of things, if it's just general standard stuff, probably not going to qualify. But in the Six Sigma world, if we're re-engineering a process, then there's components of that should qualify.
Yeah. So the fourth and final requirement is that the activities need to be done for a qualified purpose, and that is that the purpose of the research must be to create a new or improved product or process. And the process part is a hugely important aspect of the credit for A&D companies specifically. And again, when most people think of R&D, they tend to think of product design opposed to process design. So in addition to product design, process design or manufacturing process design also qualifies for the credit to the extent that it meets those other three requirements. And the other key words here are new and improved. So it's new and improved product or process. And new and improved shows us that it doesn't have to be an entirely new process being designed. If you're making improvements to existing processes, that can also qualify as long as those improvements are intended to increase things like reliability, performance, quality, etc.
And the other area that I think I alluded to earlier is again, this credit was to incentivize U.S. businesses to really become more efficient, effective, competitive. And so all the activities have to be occurring within the United States for the federal credit. And typically, I think overall, all the states have to be within the state as well that you're getting the credit. And so in some cases, we're claiming multiple state credits because each subsidiary has a facility in different states, and they all kind of roll up to the federal because they're all within the federal. But if there's outsourced engineering to India or other places, then we would extract that component out of it. So for the activities that are occurring within the United States and within the state, there's excellent credits out there.
Yep. All right. So with that said, we've got another polling question.
Yes, we do. So if Boeing or another OEM approaches your organization and requests a first article for a new part, would this activity meet the qualified purpose test? So I'll give everyone a second to reply. But Peter, just based on the last slide, correct me if I'm wrong, but it seems like the emphasis here is on process. Is that right for first article?
That's right. Yeah. So as we discussed, process improvements also qualify in addition to just new product development.
Because in a lot of cases, the first article, the first time it's gone through the CNC machine, it's not it's not commercially viable. It takes too long. It costs too much. And so that process of getting that first article into a state where, where it's actually productive and commercially productive is the potential for the R&D thing. So in some cases, it might be the first article, or it could take 20 or even more articles to really get to the point where it's commercially viable. You're able to make it for less than what you're going to be selling it for.
All right. Hopefully everyone hit submit, so I'll advance here. Good. So looks like everyone understands that definitely the first article is an important piece for, especially the aerospace industry, on generating some qualified activities.
And just there were a few that, Kurt, there was a couple that didn't know or said no, and that's fine too, because in some cases, it doesn't qualify if it's not meeting the 4-part test and other things. But if you're meeting the 4-part test, if you're going through the whole process, just if it's the first article, that's a good indicator that it does qualify.
All right, I'm going to advance, Tom, to the next slide, so maybe you can keep us going here on the what makes up the actual credit.
Perfect. So once we kind of know that an activity qualifies, the next area is what expenditures qualify. And a big area that we need to figure out is there's 3 specific components of expenses that can qualify: it's labor, supplies, and contract research. The labor is for people who are directly doing research and development, people who are directly supporting it, people who are directly supervising it. So in a lot of cases, it's the web is spreading through an organization, and I alluded earlier about the procurement person actually could qualify if they're needed to procure components for this new development. Same thing, the IRS has examples of janitors qualifying and administrative support qualifying because they're directly supporting it. The other area just relates to direct supervision. So those who are directly supervising the R&D can qualify as well. The other components, supplies, those are supplies that are used in the process. They tend to be consumed in it. So if the R&D doesn't work, they're pretty much being consumed. And the other area is contract research. And contract research is if you were utilizing an outside party that would be similar to what an activity would be for an employee, then we would capture that. And for contract research, we would capture them at 65%. For employees, if they're primarily doing R&D, if they're doing 80% or more than 80%, the IRS basically just says, they're an R&D person, capture them at 100%. If people are less than that, so potentially the administrative support or others, you might be capturing at a few percentage. But we would basically take that, multiply that on their Box 1 W-2 wages, that's by the IRS rules, and multiply their percentage by that, and that'd be their wage component. The substantially all, if an activity is substantially all qualified, then we would just capture all that, the time that's involved. So that's a big one. The other big area just relates, so Peter went through the qualifying activity requirements. I just kind of went through the qualifying expenditures, and the IRS really likes to see the nexus between those two, really linking up, here's the qualified activity, and here's the expenses that are there. So basically, if you have an Excel spreadsheet that just has a whole bunch of supplies, wages, and contractors without the nexus between the qualified activity and the qualified expenses, the IRS is going to have a big issue with that and probably have some difficulties. So, I've alluded to a couple times, but, one of the big areas, of do you pursue something like this is, how lucrative is it? How much can you save doing it? And the R&D credit, the math itself isn't overly complex. There's some different hurdles, but it would be challenging to kind of go through in a timely manner on a webcast. But typically on the federal side, it's between 5 and 10% of the qualified expenses. And then most states offer a credit as well. In some cases, it's the same or maybe slightly more. Other cases, it's less. And so, the case studies that we came up with are just some typical companies that we've dealt with. And, these are the federal annual studies savings. And on top of that, there's typically a state credit study as well, or a state benefit as well. As mentioned, I think also earlier, is just if we're doing a study for the first time, we're able to go back and capture 3 3 years for federal, 4 years for states pretty regularly. And then if there's certain things that have occurred, like the usability of the credits were suspended for years because of losses or AMT, then potentially the statute of limitations extends more. And so we're able to go back and really capture, anywhere from 20 years to 3 or 4 years. So in a lot of cases, very, very significant. And typically when we're doing a first-year study, the benefit for aerospace companies is in the $500,000 to multiple millions of dollars for if we're going back and doing 3 or 4 years worth. So very, very lucrative on companies that potentially were only making somewhat in those ranges per year. We may have just increased their net income by the same amount. So pretty positive in that regard.
Yeah, and one interesting statistic to note there is that Boeing's R&D credit, just their federal credit last year, or roughly every year, is in the range of $150 million. And that's a lot of money to a big company like Boeing. So, and that's just on the federal side per year.
Yeah, good comment. One more thing is just to make sure everybody's aware, a tax credit is a dollar for dollar reduction of taxes. So it's not an expense, it's a dollar for dollar reduction of taxes. So it's increasing your bottom line by that amount. And if you're a flow through, it's just flowing through as a benefit to your shareholders or partners for that amount. So very, very significant. On top of the credit, just to be clear, you also get the normal expensing of all this stuff. So it's not one or the other. You get both. You get the credit, which we just discussed, or you get the expenses. So very, very positive results. Peter's going to talk about some state incentives.
All right. So relevant state incentives.
I was just going to insert, Tom, if it's okay. There was a question that came in related to supplies, and just wanted to give you a heads up on it, and if you want to answer now or later. But does supplies include new product material, or is this for tools?
Yeah, that's a good one. So the supplies the way it's defined is the supplies used for the development of research and development. And so in some cases, the development of the tooling is the R&D that's occurring. Other cases, it's the materials that are doing like the first articles that are going into the first articles. And so we've seen some fairly significant ones, especially when you're dealing with sophisticated tooling that has some uncertainty. A lot of times the supplies number can be very, very significant. Yep. Peter, any other comments?
No, you covered it. Yeah.
Okay.
All right. So relevant state incentives. Here we're going to talk about state R&D incentives, and specifically for California, Arizona, and also Washington State, which Kurt will talk about a little bit. The reason being that these three states really have the most going on from an A&D perspective out of all states really in the western U.S. So one thing to note before going into detail here is that most states do offer some type of R&D incentive or some type of incentive, but exactly how beneficial the incentive is can vary significantly from state to state. An example of that is Florida, which is also a big A&D hub, aerospace hub. Florida technically has a credit, but it's capped at $9 million per year statewide in total credit claims across all companies. And that's not a per company limit. That's all companies in Florida can only come to $9 million in research credit. So that really isn't much at all, and it's kind of a drop in the bucket when you look at the size of Florida and how much is going on there. So I just make that point because the question is not only if the state has an R&D credit, but it's more importantly, it's how good is that R&D credit. And so with that said, California and Arizona actually have the two most beneficial R&D credits out of all states nationwide. It's common for companies within California and Arizona to actually generate state R&D credits that far exceed their federal credit. And from a California perspective, it's very valuable to A&D companies just because it can significantly help lower the already very high cost of operating an aerospace business in California, which has proven to be a big challenge for A&D companies over the past few decades. Arizona, on the other hand, not necessarily a high cost state, but they still offer a very generous R&D credit. And it's the single most generous R&D credit in the nation. And we commonly find that A&D companies within Arizona can completely eliminate their state tax through the Arizona credit. So,
okay.
Kurt, you want to talk?
Absolutely, Washington.
Yeah.
So Washington has very specific A&D incentives. Two that are not really specific to R&D expenditures are just one is a gross revenue tax rate reduction, and the other one is a credit on property and leasehold excise taxes for A&D, our aerospace and defense organizations. So those are sort of non-R&D related, but the other one is R&D related, which is a 1.5% gross revenue tax credit on qualified product development expenditures. So that one is in line with the research and development. And so we have a lot more information on our website on these incentives in a lot of detail. But Washington for sure has taken a very specific approach to aerospace organizations. Peter, was there any other?
Yeah, a couple other states. I mean, Texas just brought back their credit. That was gone for a year or so. And then Oregon, they have a very good credit as well. One thing for pass-throughs for partnerships, the credit's not really allowed for partnerships. Moss Adams is working right now with the legislators to change that stuff. The way it's worded right now, it's only for corporations. So S-corps are fine, which is a pass-through, but a partnership isn't. And so we're working right now to, one, make the credit even more lucrative, as well as trying to get rid of that little hiccup, I guess, in the writing of the law.
Yeah. And it looks like we had a question on some other states. So Michigan, another aerospace hub, recently did away with they overhauled their tax code, and so they no longer have an R&D credit as of a year or two ago. Ohio, on the other hand, actually has a good R&D credit. So also a big aerospace hub there. All right. So with that said, I'll pass back to Kurt for a polling question.
Yeah, this is our third one. So do most states have incentives that benefit aerospace and defense organizations? So everyone take a look at that, and please hit submit. And just in general, one general comment too is one that's out there that's not necessarily R&D specific, but that you see in a lot of states. It's just a sales tax exemption on machinery and equipment purchases. So that one is nationwide a very common one. So, okay, I'm going to go ahead and advance here. Okay, good. So I think in general, you definitely want to make sure that whatever jurisdiction you're in, or considering maybe investing in a new jurisdiction, definitely look up the opportunities related to tax incentives.
And I think Moss Adams has a state and local tax group, and if you need resources, please give us a call, because there are significant resources or benefits in pretty much all the different areas, whether it's from the city level all the way up to states and things of that nature. But overall, make sure you're finding out about it, because there are significant ones for aerospace companies, whether it's R&D or just aerospace incentives in total. So look up those ones, because they're very lucrative as well.
All right. Now, so Tom, you're going to take us into the second part of our agenda, looking at specific aerospace matters and issues.
Sure. So, the aerospace credit, or the R&D credit for aerospace, it's very specific, and I think Peter did a good job talking about meeting the 4-part test and understanding what types of activities qualify. One of the big areas just relates to the need for risk and right and of the technology that's involved. And so as we're going through there, one big area that we deal with is really just looking at the contracts. And the contracts a lot of times spell out who has rights to the technology and who has the risk. And your customer is usually very good at giving you the risk for that component, but the rights a lot of times it might be a little less clear, or it may be unfavorable to you. And a lot of times when you're dealing with you're trying to get a new sale, maybe you're like, it's a non-event, it's a paragraph, you kind of skim over because you don't really understand it or don't really know how it's going to affect you. Well, for the R&D credit, it could be very either beneficial or it could really hurt you. The other big area, as Peter went through, is the process improvements. We see this all the time where our companies keep getting squeezed by their customers. The Boeings, Airbuses of the world are basically saying, hey, we need to be doing this at a less expensive per part amount. And so they're consistently improving that process. And that development of it can be very, very lucrative as well. So as mentioned, the economic risk and the rights. So, you don't have to have exclusive rights for the IP rights, but you do have to have some. And so in some cases, the contracts are silent on that. And that's actually better than if they specifically say that, Airbus owns all rights. It's hard to say that, we have a great position. But sometimes we do have a position if what is actually occurring is the process improvement. We're not selling to Boeing or Airbus or anybody else how you make it. You're selling the final component. And so sometimes you go, wow, this doesn't look that great, but they're talking about the product itself versus the process. And so that's where it gets a little bit interesting on can this qualify, and if so, how do we document to show that it's the process we're talking about versus the product, and that the contract is talking about the product. So definitely, as we're looking for contracts, that's a big one to look at.
Tom, one question came in and says, can you apply for this credit even though a client may have helped to pay for some of the R&D effort? I think I just wanted to insert it there because I think it had to do with a lot what the contract says. Is that right?
That's a great segue. And I think the answer is definitely yes. And that's one of the bigger, again, hiccups is one, this is what we do. The first one, everyone says this is what we do for a living. So it's not R&D. It's just we're an engineering type company. That's what we do. The second one is, our customer is going to be paying us for it. And so funding is a big issue, and we're going to talk a little bit more about funding, over the next couple slides. But, the funding, if it's a firm fixed fee contract, it's pretty clear that, the risk stays with the company. If you don't deliver, then you don't get paid. That's kind of the no-brainer that one's okay. If it's time and materials, therefore the company has very little risk, then that's probably not a good one for R&D, because one of the areas is economic risk. And if you have no economic risk because somebody's paying you time and materials and there's no cap or anything like that, then that one's pretty much not going to happen. The one that in the middle is the cap contract, and that one gets a little bit a little bit muddier. And as we mentioned, this next court case is kind of one that kind of ties in all three of these areas. And the IRS said, fixed contracts, you're okay, time and materials not. The cap one, they kind of alluded to, or they did say they didn't qualify. But I think the reason that they didn't qualify is because there was no risk. In these contracts here, in a lot of our clients, there is economic risk. There are clawbacks if you don't deliver a final product and things of that nature. So again, it really determines what the contract is. The Geosyntec case, which just came out, was really more of like market. It was studies occurring, not delivering a specific part. They were doing a study, and as long as they delivered the study, they get paid. And so there was no real technological risk involved or economic risk involved, where a lot of our clients, if they don't deliver, there's going to be significant issues with their customer. And so I think in some cases, even if we have a time and materials with a cap, if it can be shown that the cap has technological and economic risk, then I think we're okay.
Yeah, and that's a big part of what we look at in the contracts is whether there's performance expectations that need to be met, very specific requirements, technical requirements that need to be met in order for the customer to get paid.
And even though this contract was a negative on the cap, there were an old court case is a Fairchild case that basically said milestone payments were deemed to be fine, and so they had, they kept on getting paid throughout the process, and the reason it was okay is because they had economic risk. If they didn't meet the milestone, they wouldn't get paid. And so a lot of our clients, again, have milestones, and they have to meet certain expectations to get paid and things of that nature. Again, time and material, probably not too good, but if there are specific expectations and a cap, there's potential to look at that and see if we can get that to work, I guess. So the retaining IP rights. So as we're doing it, again, I think I alluded to is just making sure that you're not giving up all your IP rights, and it's better to have those things silent. So as you're going through a contract, a lot of cases maybe you're like, oh, we're going to deliver the product, and it's kind of potentially it's a one-off product. It's going to Boeing. The only person who's going to buy it is Boeing. But if we can basically have some of these paragraphs removed, then there's potential for you to get a significant credit. And it doesn't really affect Boeing either because their component's going into a bigger component. So it kind of can be a win-win. In a lot of cases, it's silent or it's not there, so we're okay. But if there isn't, then let's make sure we look at it and understand how that is impacting it.
And one point to make there is that where we run into problems is when the contract will basically say that if it's a Boeing contract, that Boeing has sole and exclusive rights to the development process or to the product.
Right, very much so. Another area, I mean, we do over 200 aerospace companies and do a lot of R&D studies for them, and we look at lots of contracts, and it's kind of interesting to see that within Boeing there could be certain facilities have certain contract language and others don't, and so it's not a uniform across all of Boeing. It's very case by case and project by project what their language is. And in a lot of cases, if you have a good relationship, it can be we can change the language to be more beneficial. So that's more if we have that kind of ability, then it could be really beneficial.
All right, so process improvements, and we mentioned a few times that process improvements and new process design can qualify in addition to just product design and product improvement. So first bullet here is process improvements intended to improve quality, increase yield, or reduce scrap and defects. And this is an area where we see a lot of qualified activities for A&D companies due to the fact that the quality is such a critical component in this industry, and also due to the fact that so many of these aerospace components are very complex parts that are often machined from expensive alloys. So minimizing scrap, defects, and increasing yield are all very important qualities. Sequencing and resequencing of manufacturing steps is also a common process improvement with A&D companies. And specifically, this can be just figuring out how to optimize the order of all the various steps in a given manufacturing process. What machines do you use in what order? What are the optimal batch sizes, et cetera? So these are questions that many A&D companies really ask on a daily basis or a very frequent basis. So one of the most common opportunities, which actually isn't listed here, would just be developing new manufacturing procedures for new products or new parts, first articles, which Tom referred to. And any time your company is introducing a new component to your manufacturing line, there's likely going to be some qualifying activities to design the associated manufacturing process there. And finally, there's also a lot of opportunities related to developing entirely new processes or technologies, and that could be, for example, integrating new additive manufacturing capabilities in-house where you were previously just doing subtractive manufacturing, or even adding more advanced testing capabilities in-house where you were previously outsourcing that work.
Great.
All right, another polling question.
Yes. So when negotiating a contract, is it beneficial to insert R&D language to maximize the tax benefit? So I know Tom and Peter, you guys are always starting by reading the contracts when you dive into the research credit studies. So I would imagine that a lot of times you would hope that there was different language in those contracts.
Yeah, that's a great point, and I think I probably mentioned it.
You touched on it.
The answer might be easy because I mentioned it so many times, but a lot of times, one, the person who's doing the contract don't understand how the language affects this tax benefit, and two, sometimes they're going, well, Boeing, they're so big, and I just want to sell my parts or my components or tooling or whatever it happens to be, and so they're not they're not asking the question. And what we've seen when the question's been asked, that in some cases, and probably more than 50-50, that they get what they want, or as long as it's not affecting the person who's your customer in a bad business setting, a lot of times they're willing to work with it. So, in my mind, is if you're upfront and things are going on, then almost to the degree, well, it does actually give you a pricing competitiveness if you can actually get tax credits on the back end for a good chunk of this work. You can price this thing in a more competitive fashion than if you're not getting the credits. And so I think it's something that's worth talking about. I'm not sure if people are going to be able to get it always changed, but I think it's worth talking.
Yeah. And one thing to mention on that is that a lot of the time, the company that's issuing the contract really doesn't care that much about the language. They just put in these standard terms across all their contracts, and it's not really done for any particular reason in the case of the contract in question. It just happens to be in there because they've had it in all their contracts.
All right, so we're going to move into our last section of today's agenda. And so, Tom, if you could take us and start talking about just what the organizations can do.
Perfect. So, what can you do now? The number one thing is just understanding that the process of getting these credits is not overly burdensome, and it can be very, very lucrative. And so I've heard a lot of people like, I'm not sure it's worth it, or how much time it's going to take, or things of that nature. And then after the fact, when they're done with it, it's like, wow, that was a lot easier than I thought it was going to be. That was a lot more beneficial than I thought it was going to be. So number one is going through this presentation. Hopefully, if you're not claiming this credit, you start going, do our activities meet the 4-part test, and should we be really thinking about it? Through the process, it's always better to have documentation. The IRS likes to see that. It's not required to have it before you get the credit. So in a lot of cases, we're going back and we're amending 3, 4, and in one case, I think it was 18 years we're going back and claiming the credits for in the past. And so it's just getting a hold and making sure that we understand what the activities were, what the process of experimentation was, the uncertainty, things of that nature. And again, a lot of times the engineers, they want to talk about all the successes. Sometimes the documentation of things that didn't go well is even better for the R&D credit. It shows an agent, whether it's at the state level or the federal level, that there was uncertainty, there was a process of experimentation, things of that nature. Retaining stuff. I mean, the great thing about aerospace is there is a requirement to retain a lot of information that's very positive for the credit. So that part is usually pretty good. And then, as I mentioned earlier, is working with and getting the nexus between the qualified activities and the qualified expenses, getting the systems in place. And in a lot of cases, it's not recreating any kind of accounting systems or anything of that nature. It's using what you already have in-house and then just adjusting it or adapting it to the R&D credit. I'll keep going on to the next one. It just kind of goes on to it. Consult a professional who understands the R&D tax credit. And I think that's probably the number one area is, people like ourselves, that's all we do. 100% of our time is the R&D tax credit. So we understand all the court cases, all the law, the examinations we've gone through, things of that nature. And we understand what things are most likely fine, which ones are, in the gray area and whatnot. What I've seen is if you don't have good counsel is you only take, basically the low-hanging fruit and you lose 50% of their credit because there's a whole bunch of other activities that, that are significant that people, internally go, well, I'm not sure that qualifies. Well, talking with somebody who understands it, they'll say, wow, that does qualify because of this, and they should be able to help you. Other big area just relates to is coming up with a process that isn't overly burdensome. They can guide you through the whole process, things of that nature. As you're evaluating providers, make sure that they tour your facility, they understand kind of what you're doing, that you ask them questions, get some free consultations, and get an understanding of what the benefit could be. And early on, it's hard to say, hey, the credit's going to be this amount, but we should be able to say it's a sizable credit and it's worth pursuing. And as we come up, our goal is always to have a very customized solution for each and every one of our clients, and to really make sure that that we're providing the value. And in a lot of cases, we're working hand in hand with our clients to create systems so that way in the future it gets easier and easier. But unless you don't start claiming it, you never will get it. And this becomes an annuity for a lot of our clients. Every single year, they're getting very significant benefits. That first year, they're getting a very nice hit, but every year it just becomes part of their benefit that they're getting. And if you don't start claiming it, you potentially some of those years are falling off and you're going to lose them. So number one, just make the call if you think that you have some activities. The no-brainer, if you have activities, if you have engineers on staff, if you're designing or developing new products or processes, if you've spent significant dollars on making yourself more efficient, things of that nature, those are all good indicators. So if you have a significant engineering group, I think it's almost a no-brainer that you probably qualify unless the contracts say you don't. Peter, any other?
No, I think 2 points made there I think are really important. One is that this is just not a one-time deal. It's once you have this process set up, it is something you take advantage of every year. You pay taxes every year. So, and the other point is that if your company does have degreed engineers, then there's likely a good chance that you're going to have some qualifying activities. So,
perfect. All right. Well, key takeaways, kind of going hand in hand with that, but these credits are out there. Many A&D companies are unaware of them. The investment in the new products, new processes, you should be getting a benefit on the tax side if you're investing in those things. And the rules, regulations, they change every month or at least every year based on court cases and understanding of what the IRS and states are looking for. But even with that being said, they've been more taxpayer friendly over the last decade than less so. There's been some cases that are kind of defined it a little bit better, but for the most part, the cases are taxpayer friendly. Things that didn't qualify a decade are definitely qualifying today. The government likes this credit. They keep on wanting U.S. businesses to invest in new development, new technologies, things of that nature. And so, if you think that you may have some activities, definitely come on through. Questions? We've been asking some of the questions throughout the presentations, but do we have a few extra?
We have. And Tom, I was going to throw out a couple that I think everyone would enjoy hearing the answers to. So first one, Tom, how about we don't have the credit right now, so it expired. So what is the current status of extending the research credit?
Yeah, that's a good one. I think it was May 21st. The House passed their version of it. It's very it's very usual for credit to keep going through these cycles of expiring, and then they get extended retroactive to January 1st, et cetera. So we didn't have a credit all of 2014 until, Peter might know exactly, but December-ish. And then it was retroactive to January 1st, 2014 to December 31st. So we're entering 2015 without a credit, which is not unusual. It's kind of frustrating, but not unusual. But it just passed last week or a couple of weeks ago. The House, it passed House Bill 880, 274 to 145. And some of the areas that they're talking about doing is making it permanent. And I've heard that for probably a decade as well. But this one seems like they're getting more and more momentum on it. The other area is they're putting in something for small businesses with revenues under $50 million that are not public to be able to offset AMT with the credit. So that would be a big boon for our smaller size aerospace companies that have revenues under $50 million. And so I think it's gonna happen again. Everybody in the past, it's always won bipartisan support in probably the high 90s% range. So both parties, the GOP and the Democrats, like it, and so I think it's going to happen. The question is, when I see this, doesn't mean it's going to happen anytime soon, even though it just passed the House. A lot of times it seems like it always happens in December, retroactive to January. Peter, any more?
Yeah, when it expired, when it was re-upped last time, I believe it was done on December 31st, or right around that time. So it could very well come down to the last hour or last minute. But we are confident that it will get extended just based on the history that it's been extended many times. So.
Sure. Okay. We have one more. We have a few more, but go ahead, Kurt.
Yeah, Peter or Tom, it's a clarification question, and it's whether is the credit an additional deduction which lowers tax by 40% or 100%. So you could dive into that one.
I can take that. So the way the credit is calculated, and I'll explain this at just a very high level. So we start off by identifying qualified expenditures, and that's our qualified wages, our qualified supplies, and our qualified contract research. We calculate what that pool of qualified dollars are or what it is. That goes into a calculation, and there's other factors involved. Revenue is a factor, various other things, your prior year R&D spend. That puts out an actual credit amount, which tends to be, in the range of 5 to 10% on the federal side, 5 to 10% on the state side of your actual qualified spend. But that credit amount that the calculation kicks out is used to directly offset your tax for the year. So if you have a tax liability before this R&D credit of, $100,000, so you're essentially going to be shelling out a check for $100,000. Your tax credit's $80,000, then you only have to pay $20,000 in taxes. So it's a dollar for dollar reduction.
So you get both. You get the deduction,
yeah,
like you're currently probably doing. If you're capitalizing, it's even better because then you get to deduct it and get the expense, and then you're getting the equivalent of 100% reduction of the calculation, so of the credits you're generating.
Yeah.
So it's a add-on benefit versus a one or the other.
Mm-hmm.
Hopefully that answered that question.
Thank you. Yeah, and I was going to ask one more, but I think maybe we could maybe go into it related to just what's happening in appeals and what's happening with the current exams, but maybe what we could talk about at a future webinar is just handling an R&D type exam or appeals. So, but I think what we'll do is we'll go ahead and wrap up here, and if we have some more information that's available, and we put a few resources out there. I understand that basically there's an access point on your screen called the widget, and you can go there to access some more information. And lastly, I think this pretty much wraps up our webinar today, but I know Emily has a few closing comments.
Great. Thank you, Kurt, Tom, and Peter, for a great presentation today. As a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet in order to receive credit. If you participated as an individual, you should be able to view your CPE progress in the certification widget of the webcast console. If you met all certification requirements, you will see a download icon in the bottom right-hand corner of the widget window, and you should be able to download a PDF copy of your CPE certificate. I'll keep the webcast open for a few minutes to give you time to download your certificate. A copy will be emailed within 2 weeks should you have any difficulty downloading the certificate now. Here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. Thank you for joining us today. We hope you'll join us again next time.